Hey everybody, it's John King with Summit Funding, and I really appreciate you joining me on this video where we are going to talk about a topic that is on everybody's minds right now, which is what the heck is going on with realtors and the commissions. And my audience today, I'm talking to buyers, and I want to educate buyers on what we know. And the first thing I'll tell you is we know very little. We know a few things that are likely to change, and I want to talk about them, and I want to educate you. And I've got a special guest here today. So I want to welcome my special guest, Josh Gibson. Say hi, Josh.
Hey, Josh.
Okay.
John.
Say hi, John. Right, John. Anyway, just kidding. All right. Josh is a member of Summit Funding's corporate team. And my description of Josh's job is he's really the liaison between Summit Funding and all of the sources where we get money. And he's one of the smartest mortgage guys that I know other than me, but he probably knows more than I do about where the money comes from and how all of that works. I'm not going to bore you with all the details, and I won't let him do it either. But Josh, give us kind of just a quick 1 minute, how long you've been in the mortgage industry and kind of what roles you've served.
Sure. So I'm about to celebrate my 20th anniversary in the mortgage biz. My first 10 years was actually as an originator, just like yourself. I actually sat in many chairs in the origination side, wholesale, correspondent, and retail. So I had a nice way of sampling all of the elements of it. The whole time I had a passion for capital markets and always had a dream that I would end up in the chair that I'm sitting right now at a wonderful company that I'm sitting with. So I run our capital markets team, lock desk, product development, and a whole lot of other, to your point, some of the boring things behind the scenes.
Some of the boring stuff behind the scenes. So I want to start with what happened. First of all, you guys, if you've been following me at all, you've seen that there was a lawsuit from home sellers that sued home sellers are suing real estate agents saying, you forced me to pay for the agent that represented the buyer. And that's not right. And that's not fair. And I shouldn't have had to pay for that. Well, Halloween last year, October 31st of 23, the first biggest of these lawsuits was decided, and the jury said, yep, realtors, you did them wrong. I don't know if they really did them wrong, but that's everybody's opinion. And this jury, that was their job. And so now we've spent the last 6 months-ish, where they've been trying to figure out how do we solve this problem. And on Friday morning, last Friday, the 15th, the National Association of Realtors presented their settlement agreement. And it's 126 pages, and I've read a few of them. I've read the summary of it, and I have a real good understanding of what it means. And there's a lot of implications to this. But what a lot of people are asking right now is, John, do I have to pay my realtor's commission? Because that's one of the biggest things that's coming out right now is the question mark of, well, wait a second. If the seller doesn't pay for the realtor that represents the buyer, then who's going to pay for them? And I guess it must be me. And so that's really where I want to educate you today and give you some food for thought, because none of us have the final answer. Nobody will for a few months, but there's going to be a lot of turmoil. There's going to be a lot of confusion. And I want you to look to me as a resource to help guide you through this. And this is my first video in a series that's going to help educate you and update you as these changes come to light. Josh, any thoughts about that before I kind of dive in?
No, I think you summarized it well. There's definitely a lot of questions in the marketplace right now. Even in chairs here at a corporate office, at a mortgage company, we're trying to wrap our minds around it and just find ways that we can support the realtor community as well as the buyer community as everyone tries to figure out their way through it.
Beautiful. Now, I did ask Josh to wear two hats today. So I asked him to be the head of capital markets and helping to run, his perspective of how things work in the mortgage world. And I asked him to kind of be a consumer and to think about the questions he and his wife would have about the things that I'm talking about, to really act as you in asking me questions about how that might impact just the normal everyday buyer such as you. So let's go ahead and dive in. The first thing I want to give you is some perspective. So there was an article that came out in Housing Wire today that talked about the history of real estate commissions, and it was very interesting. I knew some of this and I learned a lot as I read that article. But one of the things that it talked about was prior to the 1990s, basically when you sold a home, the seller would hire a real estate agent and they'd pay that realtor whatever amount of money to sell their home. And the buyer came and just talked to the seller and said, hey, I'm looking to buy the house. And the buyer had no advice. The word is representation. The buyer had no advice for somebody to help them out. It's kind of like going to small claims court where you have to represent yourself, but you're up against a big company that has all of their high profile attorneys on the other side. And you're standing there thinking you went to small claims court and you're supposed to negotiate for yourself and advocate for yourself in court when you don't have any attorneys representing you. And there were a lot of lawsuits. There were a lot of lawsuits from buyers saying, hey, you didn't represent my interest as the seller, as the buyer. Well, guess what? It's because they didn't work for the buyer. They worked for the seller. And so the system changed. And back in the 90s, what happened in the mid 90s is how things have worked since then, which is the system we have now. And it's called cooperative compensation. Josh, you heard that word before?
Yep.
Perfect. So cooperative compensation didn't raise the price of commissions. What it did is it took the commission the listing agent was already paying and said, hey, as the listing agent, I agree to split this, typically 50-50, with the realtor that represents the buyer. So I'm not charging the seller extra compared to what they were charging before this change. I'm just going to take some of that money because the truth is it made it less work for the seller and specifically the agent representing the seller. So he's like, hey, I'm happy to do it. Plus, I'm not going to get sued later because the buyer has somebody on their side. So that's how things have worked ever since then. The issue with the lawsuit really was you were forcing a seller to pay a certain dollar amount. And it's true. The National Association of Realtors said you have to offer at least $1 in compensation to the buyer's agent. Now, the truth is, if you offered only $1, what are the chances that the person representing the buyer is going to ever show that home? It wasn't going to happen. So they didn't offer $1. They offered half of their commission typically. But that made the world go around. And you as a buyer were able to buy a home, get a professional to represent your needs, and you didn't have to worry about adding that to the already high number you had to come up with for down payment and closing costs. And it was built into the purchase price. So now, what's the settlement mean? The settlement is proposing that they can no longer offer any advertised cooperative compensation. Now, something interesting as I've been digging into this deeper is, and this is where the high crime drama comes in, the Department of Justice is involved. The Department of Justice has been involved for a long time going after real estate agents because the Department of Justice feels like it's collusion. Collusion is a big word. Department of Justice feels like the real estate world is working together inappropriately to milk more money out of buyers and sellers. And so the DOJ, from everything I'm reading, would prefer that the listing agent and the seller are not allowed to pay a penny ever for the buyer's realtor's commission. That's not the world we're in right now. There's some people thinking that by summer, that's actually what's going to come about, which I'll talk in a couple minutes about what that's going to mean or the potential impact to what does that mean to you as a buyer? What does that mean to your mortgage and your down payments? And that's where Josh is going to come in and help us out. But what's really changing in this settlement, and the part that you as a buyer have to fully understand, and Josh, I'm going to use you as the example. Right now, Josh, if you and your wife wanted to buy a home and you didn't have a realtor that you knew and you were just feeling like, you know what, I just want to see what's out there, tell me the truth. What would be the first thing you would do?
There's a high likelihood we'd be rolling around a neighborhood on a Sunday afternoon. We'd see an open house. We'd stop in, and there to greet us would be the seller's agent for that property. And
Perfect.
we'd probably engage in some conversation. And as long as we felt comfortable working with them, there's a high likelihood we'd have that person represent us.
Yep. What that is called is dual agency. So I said back in the 90s, they changed it so that you have agents, somebody that is your agent on the seller side and somebody that's your agent on the buyer's side. The same person is allowed to do both. Well, that means that in the previous world, they'd make twice the amount of money because they agreed to split the commission with the person who brought the buyer. But if they got the buyer themselves, then they got twice the amount of money. Now that's twice the amount of risk. Because Josh, you're going to this agent represents the seller. How neutral can that agent be if they're negotiating between you and the seller? Can they truly, fully negotiate with your best interest at heart and the seller's best interest at heart?
No, it feels like they probably have to compromise on one side or the other.
And that is actually the single largest reason why realtors get sued today. Trying to represent both sides, trying to serve two masters, trying to make both sides happy when it's impossible. There's a word called a fiduciary. Josh, you know what a fiduciary is?
Yep.
Okay, so a fiduciary is someone who has a legal obligation to put your best interest in front of their own. Okay, so I'm going to talk a little bit about fiduciaries as we go through this conversation. But your realtor is a fiduciary. Well, the realtor signed a fiduciary agreement with the seller first. And now Josh, in his situation where he went to an open house, says, well, I'm going to represent the buyer as well, but I got to put my seller's interest first, and I have to put Josh's interest first. Great, I have to put them both in front of me, but how do I put them in front of each other?
And John, how's the commission set?
How is the commission? They make double the amount of commission because they get the full amount.
What's it based on?
The sales price of the home and the dollar, the percentages. That's a funny thing. I'm going to take a quick side note here. So many articles have said recently. As a matter of fact, today, the president of the United yesterday, President Biden was in Las Vegas, and he said, for the first time in history, sellers and buyers can negotiate how much money they pay their real estate agent. It's been always in history that you've been able to negotiate how much you pay. Now, the only person negotiating is the seller.
But I bring it up because
anything to do with that.
Negotiating the purchase price, a lower purchase price would, because they're based on percentages of the purchase price, would also mean a lower commission amount. So if a agent was to lean to one side or the other when representing both sides, they might lean towards keeping the sales price higher and representing the seller a little.
Because that lines their pocket with more money. Now I get where you were going. So you are 100% correct. I wasn't picking up what Josh was laying down. So I dropped that ball. All right. So here Josh is in this situation where he went out and he found a home through an open house. Many of you are going to do that. And now you have a choice at that moment. You can say, well, no. Hey, I already have a realtor. I'll use them to write an offer, which is fine. Perfectly fine. And you go and your realtor writes the offer on the home. Everything is great. Okay. Or you can use that agent. You don't save any money. Some people think you do. Some people think, well, if I go to the listing agent, then I get to offer the seller less money because they only have to pay for one realtor. That's never been true. The funny thing is that now theoretically is going to become true, but not in the way you think. So Josh, let's pretend you didn't go to an open house. How else would you start searching for homes?
Probably go online.
You go online. We can say it. Name a website you might go to.
Zillow, Redfin.
Yeah, all of them. Okay. We all know the names. I'm not promoting them. I'm not talking badly about them. I'm not anything. We're not affiliated with them. I don't own their stock. I don't know how many. Josh doesn't either. Okay. But we start with those companies. And so a lot of people are going to say, hey, well, with this whole thing with realtors, the agent that represents me as the buyer, they don't do a lot of work. I mean, the truth is I found the house myself. And the truth is, years ago, that was the hardest thing to do, was to find the home. And now Zillow and Redfin and everybody has every single home listed for sale is on there. They get that information from the local MLS. That's called the Multiple Listing Service. And the local MLS sells that data to the aggregators. That's the Zillows and the Redfins of the world. Well, here's the problem. Here's the disconnect. If the MLS doesn't survive this whole settlement, and there's a chance it doesn't, Zillow won't know what's for sale anymore. It's a really interesting kind of twist on this that could happen. I'm not going to go too far down that road. But for those of you who say, hey, no biggie, because I can find my own house on Zillow, if there's a bigger collapse in how real estate works and the multiple listing services don't survive this change, there's no way for Zillow to get the data. And now we've lost visibility of what homes are even listed for sale in the market. Now you need a realtor even more to even know what's out there. So there's some weird unintended consequences that could happen. But here's what ultimately is going to happen. Josh, when you go on Zillow, you find a property you like, and you click the button that says, show me that property. Okay. And I don't know if you've ever done it or not, or if you can imagine how that process works. But what do you think would happen next?
Within about 30 seconds, I get a phone call or a text or an email or all of them from an agent at Zillow.
Yes. Or an agent, maybe not working for Zillow, but an agent who has paid Zillow money. So the buyer's agent's writing a check to Zillow for the right to get your name and phone number. And you're going to say, I'd like to go see that house in a couple hours. And they're going to say,
sure,
no problem. All right, let's go. Now, here's the thing in the new world, a big change in the new world. After mid-July, this is the proposed deadline. You as the buyer, before you're allowed to see a home, have to negotiate in writing and agree to how much money you're going to pay that realtor. Josh, how much money do you have lying in your pocket right now to pay your realtor if you're the average first-time home buyer?
Well, based on a lot of the loans that we see here, there's a lot of very low down payment loans happening right now. So not much.
Not much money. So before you can see a house, you're going to call the realtor. You're going to say, hey, I want to see this house. And they're going to say, great. What's your email address? I'm going to email you an agreement that you're going to pay me a certain amount of percentage of the home price if you buy it. Don't worry. We're going to ask the seller to pay that on your behalf. But if they don't, you're responsible for paying that. How are you going to feel at that moment, Josh?
Nervous. I'm probably going to step back from my home shopping, pause a little bit, have a conversation with the wife, and figure out what we're doing next.
And have you ever, based on what we just described, have you ever met that realtor before? Do you know anything about him?
No.
Are you interviewing realtors at that moment, or are you looking for homes?
I was just looking for homes. I just wanted to walk in a house and take a look and just kind of see what it was going to cost. I might have only been dabbling at that point in time.
Yeah. In the new world, you won't be allowed to do that. In the new world, if you call your favorite realtor that you've always used, or you call a brand new realtor you've never met, they have to get a signed agreement that said it's between the buyer and the broker. They're your broker, and you're agreeing to pay them a certain amount of money as a percentage if you buy something. Now, what's unknown is, and really, I think the realtor is going to have a choice. The realtor can say, hey, I've got to have you sign an agreement that if you buy this house, we have to agree on how much you're going to pay me. Some realtors, and the current agreements that exist right now that most realtors don't use, say, if you buy any house in the next 6 months, you're paying me this. How are you going to feel right then going and wanting to see a house and having to commit to using that realtor for the next 6 months?
I probably would not.
Right. So there's going to be changes. I'm not telling you that every time you go to see a house, you have to marry a realtor for the next 6 months. But I'm saying those are the current protocols when you sign a buyer-broker agreement. And I think that's going to change a little bit because nobody's going to want to jump into a relationship with a realtor for a long period of time. But it is something that's out there that's unresolved about this whole thing. What is clear, if this settlement is accepted, and it's expected to be accepted, that you're going to have to, as a buyer, sign that agreement, and you're going to have to agree to pay a certain percentage. Now, let's talk about the other side of it that we discussed, which is the seller can no longer automatically offer to pay for your realtor online. When I say online, I'm saying they can't market to other realtors saying, hey, I'm going to, on the public MLS and multiple listing service, they can't say, hey, we're going to offer this much money. Now, some realtors are going to tell you that don't worry, nothing's going to change. Every seller is going to offer a certain amount of money to pay the buyer's agent. Maybe, maybe not. Because if I was a seller right now and I knew that a lot of people were going to want to buy my home, I'm not sure that I would want to give up commission to pay for the realtor on the other side when I feel like there's going to be a lot of people competing to buy my home anyway. But here's what's more important. That offer is not binding. That my understanding is even if they call, so the realtor says, I'm just going to call the listing agent and see how much money they're willing to pay. Oh, they're willing to pay X percent. By the way, we're not allowed to talk percentages. I'm not a realtor, but that's part of the problem is they're not allowed to set numbers, okay? But if they said, hey, the seller agrees to pay X percentage, and so we're going to agree before we go look at that home that's what I'm going to get paid to buy you, the buyer. What if when you write your offer, you have to include in your offer, this is the next more important part. You still have to negotiate it with the seller. It's not guaranteed. So Josh, rewind back to 2020 and 2021. How many people were writing offers on homes back then compared to homes that were listed for sale?
It was 10 to 1.
Yeah, easily.
If not 25 or 50 to 1 in some markets.
Yep. And Josh, you heard of people waiving appraisal contingencies?
Appraisal contingencies, financing contingencies.
Yep.
Anything it took just to push their offer to the top of that stack.
So let me explain to all of you watching what that means. Back in 2020 and 2021, you were competing with at least 9 other people on most homes to buy that home. And so you had to figure out how to make the seller want to accept your offer. So you could offer only 2 things: price, giving them a better price, or terms, making it a cleaner offer. But one of the terms you can say is, hey, I'm waiving my right to cancel if there's a problem with my loan. I'm waiving my right to cancel if there's a problem with my appraisal. That was a big risk to the buyer, but it became the standard because you had to do that to compete. And I fear that could be an unintended consequence as we continue. We're still in a tight housing market. The difference is right now rates are up. And with rates being high, a lot of buyers are sitting on the sidelines. Some of you probably might be sitting on the sidelines because rates are up and payments are higher than you're comfortable, and you're waiting for rates to come back down, and they will. Okay. When? Well, I don't know. I call Josh every day and say, hey, what are rates going to be tomorrow? Josh, what do you say when I ask you that?
I don't know. If
Call
I knew
me back
that,
tomorrow.
I'd be playing lottery.
Nobody knows. Nobody knows. Okay. But we know they're going to go down. And at some point, when rates are lower, those people are all going to jump back in the market, and there's not going to be enough homes for them to buy. And my fear is that this commission is now going to be a negotiation where the seller says, well, yeah, I was willing to pay 3%, 2%, 1%. I shouldn't be talking percentages, but that's the range that has been typical. And the seller says, yeah, I was willing to pay that, but I got 10 offers and 8 of them asked me to pay that. 2 of them said I didn't have to. If you're a seller and you have 2 people that say, hey, I'll buy your house for the same price as everybody else, but you don't have to pay for my realtor, Josh, who would you pick?
I'd pick the one that gives me a better bottom line when I net out all of the fees from selling my house.
Yes. So even though they're allowed to pay for you, it becomes part of the negotiation of the back and forth. Okay. So that's going to be one of the challenges. Now I want to transition as we talk about kind of what the process will look like going forward. And I already started talking about some of this, which is you're going to have to sign a buyer broker agreements at the time before you go see a home. That we know for sure is going to happen. And if the seller is unwilling to pay the amount that you agreed to pay your agent, the buyer is responsible for the difference. I'm going to bet that the agents are probably going to have the ability to lower that. Now, that's just my own guess, but I think they're going to have the ability to renegotiate that agreement to give you a break if the seller is willing to cover only a lower amount. But the seller might come back and say, I'm not willing to pay anything. And now you and your realtor have a big decision to make, because your realtor technically is owed a commission for helping you find a home. They get paid nothing for all the time that they've spent showing you homes, driving you around, doing all that stuff. And now their income, it's kind of like your employer, Josh. What would you think if your employer said, hey, every month we're going to evaluate at the end of the month and decide whether we should pay you for the work that you just did? How likely are you to show up every day?
Yeah, but that would have a pretty big impact.
That would have a pretty big impact. That is, by the way, what realtors do regularly, is not because somebody's deciding if they're going to pay them, but because if they don't achieve the result of getting you a home, they get paid nothing. Now we're adding to the fact that even if they do achieve the result of getting you a home, it's possible that the person who used to write their paycheck, the seller, will negotiate their payment out of the deal. So now that brings up the question of how in the heck are buyers expected to pay for this? Now, this should seem simple, and this is actually probably the most complicated part of it, because there should be just two options. Hey, fine, the seller isn't going to pay for the realtor, so I can just write a check for it. It's no big deal. It's actually a pretty big deal, and I'll explain why in a second. The other option people are saying is, well, then I can just include it in my loan. The answer is maybe. And even if you can, it's likely to cost you. And so, Josh, I want to pick your brain a little bit on something called high cost.
Mm-hmm.
Could you give us just a very short tutorial of what does high cost mean to a buyer getting a mortgage, and how does that impact them?
Super high level. It is a federal regulation that is in place to protect the borrowers from overpaying or being taken advantage of by layers and layers of fees in mortgages. And so what it does is it aggregates all of the fees that a borrower is paying, including title and appraisal and APR, and it rolls all of this into a super complicated calculation that we have to have software that ultimately manages and tests for us. But once a loan comes in, we run it through that software, and it tells us if a borrower is below that threshold. Typically, that is somewhere around 3 to 5% in total fees.
Okay.
Again, that is influenced by APR of the mortgage and things of that nature as well.
And I would venture to say, and Josh, you can tell me if you think I'm right or wrong, or you can refuse to answer, the average mortgage for the average buyer, when you go all in, is anywhere from 1.5% at the absolute lowest, because you got to pay the appraiser and the title company and whatever. So you're typically around 1.5-ish% on average at the low end, to 4 or 5% on average at the high end, with lots of different reasons in between.
Yep, and this market right now where we're at in rates actually compounds that a little bit, because there was a period of time where when rates were lower, it was much easier to get what we call a par rate, which is a rate where you don't have to pay discount points to get that specific interest rate. Nowadays, it is not uncommon for borrowers to have to actually pay discount points, and that can be anywhere from 1/4 point to 1.5 points. So that plus all of those other fees that you just outlined adds up very quickly.
Josh, I'm smiling because I knew where you were going when you went to par, and I was grabbing my popcorn because I thought it'd be entertaining to see how you navigated through that discussion, and you did very, very well.
All right.
Freddie Mac did a survey. By the way, 92% of all survey results are made up. I'm making up what the results were, but the concept is spot on. Freddie Mac did a survey last year. It came out earlier this year. Josh, you may have actually read it, and they said something like, 60+% of buyers in the last year paid 2 points on their mortgage. Like it was a very high number, higher than it had been in recent history. And what's funny is that when rates are high, it's actually the worst time to pay points to buy down your rate. But the dynamics of the market kind of make it necessary. And it will bore you with all the details of why. But here's the deal. If the most we're allowed to charge you ish is 3 to 5% ish, depending upon what state you're in and all the different things. I'm going to put ishes all over this. And we're already within a close proximity of that number. And now you add a payment to your realtor. I might not be allowed to do your loan if the high cost rules don't change.
Because what if that's not a financing fee, John? What if that's just a fee to my realtor?
But it's showing up on your settlement statement. There's a spot on the closing disclosure that shows what is being paid to both realtors and who's paying it. Now, some fees are excluded from some of the high cost tests, but we've never been in an environment where buyers really ever are paying for their realtor. I'm not sure that anybody's fully vetted whether that fee is excluded or included in high cost. Josh, do you have any gut feeling?
Wouldn't even want to guess right now.
Yep. And he's the smartest guy I know in the world. Okay, maybe not. Anyway, close. Yeah. But that's the challenge that people don't understand is even if you have the money to pay for it, if it's part of the cost of your transaction, it's kind of like when somebody comes to me and says, John, I want to buy down my interest rate. And on this chart, it says I can buy it down all the way to 5% interest rate. but it's going to cost me 10% of the loan amount. Well, I want to do that. That's worth it to me because I know I'm never selling this house. I'm positive I'm never selling this house, and that's worth it. I'd like to do that. Josh, am I allowed to give them that even though the chart says it's available?
No, you would fail that high cost test at that.
And I can't do the loan. Like, I literally, handcuffed, cannot fund the loan. There are
John, what if my grandma wants to help me with that fee?
It still is a fee that you as the buyer are obligated to pay. Just because it came from a gift still says it's part of your cost of buying the home. And so I'm hopeful that this can be excluded from the high cost fees, but I don't know. If it's not already excluded, I'm hopeful they're going to make that change. But that's the first biggest thing that we don't know about. And I want you to be clear. This isn't going to impact just you, Josh, or just the person that's watching this. And so the market's got to figure out a solution to it. Like,
well, I can tell you, we've had conversations with Fannie Mae and Freddie Mac. They're not actual real people. They're institutions, but people that work at Fannie Mae and Freddie Mac, and they don't have an answer to that either. So unfortunately, a lot of these legal cases are decided and decisions are made in a vacuum, and nobody consults all of the industry experts before coming down with regulation. So there's a lot of people still figuring it out. Even though you are the smartest guy, John.
Thank you, Josh. That is the most accurate thing you've said this entire podcast. So Josh, you brought up Fannie Mae and Freddie Mac, super nice people. So that's the other side of it, which is everybody says, oh, don't worry, we'll be able to include it in our loan. Now, Josh, if I'm putting 20% down and I want to not have to pay extra closing costs out of my pocket, could I just borrow more money?
No, unfortunately, it's not something that can be, not in a purchase transaction.
Well, what if I only put 15% down and now I took that 5% that I didn't put for a down payment? I could now free up that cash to pay for the seller's, for my realtor's commission. Is that mathematically that would work, right?
Unfortunately, no. The financing is only based on the cost of the home and what the purchase price of the home is to acquire it.
Okay, so let me say this a different way because, Josh, this time you're not picking up what I'm laying down. If I'm putting a big enough down payment, I can choose, if I'm putting 20% down, to just put 15% down.
Hold on, I found it here. Yes,
you found what I
put less down, and in that scenario, you would have 5% of whatever the purchase price was in excess funds that you could then spend on fees if you would choose. Yes.
Ignoring high cost. Okay, we talked about high cost. I'm ignoring that now because we don't have an answer to it. You could free up money.
Yes.
You could also have the seller give you a credit towards your closing costs. But now that's something called an IPC. So Josh, explain to me what an IPC is.
IPC stands for Interested Party Contribution. And back to our friends at Fannie Mae and Freddie Mac, in their wisdom to keep people from manipulating the purchase price negotiation process, they have put caps in place that say a seller or an interested party, realtors are also interested parties, have a maximum that they,
no, I guess we're not. In some way.
They have a maximum that they could contribute towards concessions or negotiations back to the buyer. And those are set by the LTV or loan to value ratio, how much money you're putting down on a property. They're set by that. So the more that you put down, the larger contribution the seller or interested party can provide to you. Those typically range between 3 and 6%.
Yes. This is my favorite, what the heck were they thinking moment of the mortgage world. So the math goes like this. If you're putting 10% down or less on a conventional loan, the most you can get from the seller is 3% credit. But if you're putting between 10 and 25%, so you have more of your own money to put towards the transaction, then they'll let the seller pay more. It seems a bit backwards. Like, don't you need more of the seller's help when you have less money? But that's not how our friends at Fannie and Freddie think. And I understand that. It's not ours to make their decisions.
We don't judge.
We don't judge. But if you get more than 25% down, the seller can pay 9% towards your closing costs. But I don't need 9% help because I've got 25% of my own down payment. So very, very crazy rules. But it's critical to understand that, because maybe you said, hey, I need the seller to pay my closing costs. Cool. Then FHA says the seller can pay up to 6% of your closing costs, even if you're putting a super small down payment. But now you might have 4.5% of your purchase price and closing costs, and then another 3% to pay your realtor. That exceeds how much the seller's allowed to pay. So now we have to wonder, is Fannie Mae and Freddie Mac and FHA and our friends at VA has a whole different rule, and that one's really fun to play with. We won't get into that. Are they going to change those rules? We don't know. But here's the most important thing, because other people, and I'll get to the most important thing in a second. What I want to point out is when you are so we talked about when you're putting 20% down, well, I can put 17% down, and that frees up 3% of my money, and I can pay the realtor, and it's no big deal. But if you're putting 3% down on a conventional loan, Josh, can I just put less down?
No, that is the absolute minimum.
That's it. So will Fannie Mae, because I've heard many realtors say the government's going to solve this problem, they're just going to let us include it in the loan amount. They're just going to let us finance it into the loan. What are your thoughts about that, Josh?
So one, I think Fannie and Freddie are very focused on affordable housing, and that is very important to them. So I guarantee you there's people sitting around a board table right now trying to figure out how to accommodate these changes.
Yes.
That said, you still can never finance more than a property is appraised at. So if you're putting 3% down and you're going to finance 3%, you are now basically financing 100% of the property, and that's not something that Fannie and Freddie are. That is an area I don't see Fannie and Freddie bending on.
Now, VA goes there. VA will loan me more than 100% of the sales price, because VA will add a fee in there that VA charges on top of the client putting zero down. So if VA will do it, then everybody should.
Unfortunately, these agencies all have their own offices in Washington, D.C., and they don't rarely cross the street to talk to one another about their policies.
Here's all. I love your answer. Here's what I'll say. VA is specifically designed as the most flexible loan program to take care of the people that sacrificed some of them their lives, some of them their livelihood, all of them a portion of time in their life for our country. They deserve to have the most flexible way to finance a home. And so for anybody to say, well, they do it on VA, so we should do it everywhere else. No. VA loans do things that no other loan will do, because you men and women who have served our country, you deserve better treatment than everybody else. So I don't want people comparing and saying it should go that direction. It should not. And the bigger piece of this is, Josh, when Fannie Mae, when we do a loan that meets Fannie Mae's guidelines, well, and I'm asking this question tongue in cheek, that money comes out of the federal government's checkbook, right? Like Fannie Mae just writes a check. That's their own money that the federal government is giving for this loan, or is it?
So I'll save you all of the boring capital markets answers to all of that, but no. In most cases, it is private institutions that choose to invest in mortgage-backed securities that are backed by the fact that Fannie and Freddie have guaranteed a loan that is underwritten to their criteria will perform.
Perfect. So I'm going to give you a quick scenario here. I don't want to go too deep down the rabbit hole, but there's weighted risk within a pool of loans. Okay. And I want Josh to confirm it. I already saw him shaking his head, even though the camera is there, but Josh's face is right there. So I'd have to look like this to see. So out of the corner of my eye, I saw Josh shaking his head. So there's weighted risk. So Josh, you could do conventional loans as low as 620, but would any investor buying a pool of loans buy an entire pool full of 620 credit score borrowers?
The potential is yes. I know that's not the answer you're looking for, but they would pay significantly less for that security if that was the weighted average of the FICO scores in that particular pool. So we strategically mix characteristics, loan to value ratios, debt to income ratios, credit scores. We mix them in a weighted way that make them that pool of loans as attractive as possible.
So it's the end investor that ultimately decides what you pay as an interest rate. It is not Fannie Mae or Freddie Mac. And so Fannie Mae says, because what Josh said in technical language of what we would get for that pool of loans would be lower. What it really means is, hey, if all we did going forward with 620 credit scores, everybody would have a much higher interest rate. Is that a fair statement, Josh? Because the risk is higher. So if every loan was borrowing, let's say Fannie Mae said, no problem, we'll loan 100% of the value. We'll let that happen. The end investors are going to demand more interest, more income to offset the risk of the fact that the buyers have even less of their own money into the transaction. Is that an accurate oversimplification?
That is an accurate oversimplification.
So there is a chance Fannie Mae says we're going to raise that and allow you to finance that. But that ultimately is going to lead to a higher risk loan. Your mortgage insurance fees might go up. There's lots of moving parts here. Okay. So ultimately, what I want to point out is everybody is in this same boat. Everybody. So whether you are thinking, oh my gosh, I shouldn't buy a house right now because I don't know what's going to happen. The truth is, we don't know what's going to happen, but we know the housing market is not going to stop operating. We know that we went through 2 major times of change in the last 15 years. Josh, you remember, you know what I'm getting at from the mortgage industry, what the 2 major changes were?
We had Dodd-Frank and we had an absolute meltdown in the mortgage industry.
Yes. And the second one was TRID, which it's called Tiller Respite Integrated Disclosures. We had to change every piece of paper we gave to you. We had to change every timeline of when we provided it to you. And there was a good 6 to 12 months of challenges. And then we got to the other side and everything is fine. And that's where we sit right now. We're at the moment right now where we're going to deal with 6 to 12 months of challenges and unknowns. But the good news is we've got super smart people like Josh who are talking to super smart people at Fannie Mae and Freddie Mac. We've got smart people on the real estate side who are trying to figure this out. But don't stick your head in the sand and think nothing is changing, because there are a lot of things that are changing, but you need to figure out where to get your information from. And I hope you choose me. I hope that you choose to allow me to guide you not only through this maze of how do I pay for my realtor, but to guide you through actually getting the financing, because that's actually how I get paid. You may think I'm a huge YouTube star and I probably make as much money as Mr. Beast. By the way, most of you probably don't know who Mr. Beast is. But anyway, that is not true.
15-year-old, I know.
Right. The truth is, I get paid to do mortgages. I get paid to help guide you through the process, and at successful completion of that mortgage, I get a paycheck. No different than your real estate agent. And you need to have that real estate agent on your side. So continue to join me, continue to listen in, and allow me to guide you through the process. And if you are ready to start the process, the QR code that's been floating right above Josh's head, take a picture of that. That takes you straight to my website right there. Yep, Josh, you got it. It's like, how does the weatherman do it? Like the weatherman literally is pointing at Idaho and saying the wind stream's coming in here, and Josh can't figure out where the QR code is over his head. Okay, those people are talented. Right. Josh, any final thoughts? Any comments that you have, just whether it be from your position as your role as a job, or from a consumer on what you think about our discussion today?
No, I think you nailed a lot of it. What I would just say is lean on the professionals in this industry like John. Don't sit on the sideline. Don't let this be a reason that you don't get engaged. There are people that will walk you through this process and figure it out for you.
Love it. Ladies and gentlemen, I appreciate your time today. Please reach out if you have any questions. I'd love the opportunity to serve you. Have an amazing day. Bye-bye.
Everybody.